I just got a margin call and I owe Robinhood $148,000 because of some credit spreads, and this could happen to you too. But lucky for you, I have the fix. Welcome back to Everything Options. My name is Greg, and today we're going to be talking about credit spreads, early assignment, and margin calls. So to break this video down for you, first we're going to talk about why this happens in the first place. Then I'm going to teach you how to prevent it from happening. And finally, at the end of this video, in case it does happen to you, I'm going to show you exactly how to fix it. But before we get into it, if you learn anything out of this video, or if you just enjoy it, make sure to leave a like down below. And if you have any questions for me, leave them down in the comments. Thanks. The reason why you might get assigned early on an option that you sold for a spread is that there's somebody on the other side of that trade that bought that option from you. And that person that bought the option has the right to buy or sell 100 shares of the stock at the strike price that they chose. You, as a seller for that option, have the obligation to buy or sell 100 shares of the stock at the strike price that you chose. When you get assigned on selling a put option, you're agreeing to buy 100 shares of a stock at your strike price, and whenever you sell a call option, you're agreeing to sell 100 shares of your stock at your strike price. The great thing about this, though, is that if you're trading out of the money spreads, you're actually pretty safe in comparison to trading in the money spreads, because in the money spread actually has some intrinsic value, which means that a buyer can actually exercise it and you would get assigned on an in the money spread. When the option becomes deep in the money, that's when you really run the risk of assignment. And once the expiration date comes closer and closer and closer, the extrinsic value for that option, or the time value that's left in it, just dwindles down to almost nothing, because extrinsic value is made up by two factors. First, time, of course, and second, how close the stock is to the strike price for your option. Now, this follows a bell curve where options that are at the money or right at the current share price have the most extrinsic value, and as you go away from the strike price to either side, the extrinsic value for that option dissipates. So a deep in the money credit spread with very little time until the expiration has almost zero extrinsic value. Now, the option that I ended up getting assigned on was a really great example of this. So this option was already out of the money whenever I opened it. If you see, the strike prices were $275 and $280 on October 14th, and back then Microsoft was trading for $302.75. But anyway, I ended up getting assigned on the $275 call that I ended up selling for this option, which means that I needed to sell 400 shares of Microsoft at my $275 strike price. And you to pay, it's great and all, but I don't have $115,000 to drop on a single stock. I don't have it like that yet. And I'll teach you how to deal with this sticky situation later, but for now, let's talk about how you can prevent it in the first place. And we already touched on this a little bit, but let's get a little bit deeper in it. The number one best thing that you can do in order to avoid this altogether is by starting with an option that is out of the money. That way, the option's buyer has no reason to want to exercise that option. Because the thing with an out of the money option is that it makes no sense to exercise. Think of it this way. XYZ stock is trading for $100 and you sell a $110 call within a credit spread. The person that bought that call from you, the $110 call, is agreeing to buy 100 shares of XYZ stock at $110. But the market price, the price that XYZ is currently going for, is $100. So why would they want to pay $10 more per share for 100 shares of a stock? Doesn't make a whole lot of sense, right? So going with an out of the money spread is advantageous if you don't want to get assigned early on a credit spread. And the second thing that you can do whenever it comes to credit spreads, if you want to avoid assignment, is closing your options long before the expiration date. Now, the problem that I had with my Microsoft call credit spread is that it only had about a week until the expiration, and it was so deep in the money. So both of these things were going against me. But if I had, closed out of this a day or two ahead of time before I ended up getting assigned, then I wouldn't have had to deal with the situation altogether. But unlucky for me, I ended up trying to wait closer to the expiration date, see if Microsoft would make any sort of movement towards the downside to where I can at least reduce my risk, and obviously that ended up panning out pretty poorly for me. And I just want to say that there's no rule on you can't exercise before a given date, before the expiration date. You can exercise a option that you bought anytime before the expiration as long as it's in the money, but the problem with it is the more time that your option has, the more extrinsic value it's going to have inherently. For example, if we look at the same strike price for Microsoft and we set our expiration date to 3 months out, so maybe February 18th, 2022, and we go to the $275 strike price that we had before, this option is going for $68.88. Now, if we take the difference between the current share price of $341.41 and $275 strike price, this option has $6,641 of intrinsic value in it, but the option itself, again, is going for $68.88. So if we take $68.88 and subtract that from $64.41 of intrinsic value, this comes out to $447 of extrinsic value that is related to time. So if the person were to exercise this 3 months ahead of time right now, then they would be given away that $447 that could otherwise go towards buying the shares. Because essentially whenever they open this 275 call that's going for $68.88, they're agreeing to buy 100 shares of Microsoft at $275, but they're paying $68.88 for it. So you add $68.88 to the $275 strike price for a break even of $343.88. Right now, Microsoft is going for $341.41. So they'd be paying $2 more per share, a little bit more than $2 more per share on 100 shares of Microsoft. And I don't know about you, but I like paying less for stocks and not more. And I think that goes across the board for most people. So in most cases, it doesn't make sense to exercise an option with a longer dated expiration and one that is out of the money. So these are two things that you can do in order to prevent this from happening in the first place. But if you do end up getting into the situation, here's the fix for you.
So now what I'm going to have to do is basically pull out the reverse Uno card and exercise this $280 call that I bought. So I got assigned on the $285 call that
SWP
I sold
audio capture
to sell the
not
100 shares
registered.
at $285, but buying this $280 call means that I can exercise this to buy 100 shares of Microsoft at $280. But since I don't have $148,000 in my account, the broker is actually going to do this for me. So this is the whole purpose of having a margin account. If this right here ever happens to you, you couldn't do this with a cash account. It would literally be impossible because you wouldn't be able to go into a $148,000 deficit. So what I'm going to do here is exercise this option, and we're not going to show again. We can continue. And then so it outlines the reasoning right here covering the in early assignment. So we got assigned early on the 285 call that we sold, and now we're exercising the Microsoft $280 call, expiring the same date. So again, trades balance themselves out. You're buying 100 shares at $280. You're selling 100 shares at $285.
SWP audio capture not
this means that I'll
registered.
actually be taking max loss. You win some, you lose some. So we'll continue the trade. Should you still exercise, just going to make sure that this is what you want to do, because if you didn't know what you're getting yourself into, you might run into some trouble. Having to buy 100 shares of Microsoft $280 is almost equally as expensive as selling 100 shares at $285. We're going to continue this trade. All 4 contracts. Strike price is $280. Total cost is $112,000. It's really funny to see these gigantic
SWP
numbers.
audio capture not registered.
I've never really had this happen to me before. So I'm glad that I can share this experience with you guys. If you guys ever run into it, just let me know. I can take you through the same process and, help you out the best that I can. And so this has been queued to exercise on opening on Monday. and this is probably going to piss off somebody else. It's like a chain of events of, somebody exercised on me, now I exercise on somebody else, and that just keeps on going on and going on. I guess that happens kind of in the last week of the expiration date, depending on how far you are in the money. So this is a risk you need to be aware of whenever it comes to trading options, especially with spreads. I almost had a heart attack whenever I saw my account was at $148,000 deficit, but luckily I was able to work through this, and luckily I was able to share this experience with you guys. So, yeah, it's pretty great.
Now, something important that you want to keep in mind is whenever you exercise the option against the option you get assigned on, your account is still going to be in a deficit, just like mine is right now. And it says that your margin call has been covered, but your account will be restricted until the next trading day starts. So you're going to have to sit on the sidelines, sit on your hands until the next trading day. And if you're a frequent trader like I am, this can really slow you down in your trading career if this continues to happen over and over again. I've actually had this happen to me twice this week now, so I've had to sit out 2 days of the market, but luckily I have some other brokers that I can buy other stocks on if I need to. So hopefully you learned something out of this video, and if you did, make sure to show some love, leave a like. Thanks for making it all the way to the end, and thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.